All right, let's jump right in. Today, we're digging into a real giant in the energy space, a company that's making some fascinating moves in a very tricky market. I'm talking about Phillips 66, and their ticker symbol is PSX.
This really is the big question for pretty much the entire energy industry, right? How do you keep things running today while also building for a totally different world tomorrow? Well, Phillips 66 seems to have a pretty compelling answer. So here's the bottom line, the central idea we're going to unpack. PSX isn't just another old-school oil and gas player. Nope. Think of it more like an integrated powerhouse that's got a really clear game plan for growth, for paying back its shareholders, and for getting a serious foothold in the energy transition. Okay, so before we can really get that strategy, we've got to pop the hood and see what makes this engine run. What are the actual pieces that make Phillips 66, Phillips 66?
So the company is really built on four main pillars. The biggest one, the one most people think of, is refining. That's where they take crude oil and turn it into stuff we use every day, like gasoline and jet fuel. But, and this is super important, they also have these other huge businesses in midstream, chemicals, and marketing. That mix, that diversification, that's absolutely key to their stability. And this right here, this is their secret sauce. It's what they call their integrated model. Think about it. They handle the whole journey. They process the crude, they move it through their own pipelines, and then they help sell it. By controlling each step, they get to keep a slice of the profit along the way. It's a huge deal because it shields them, at least partly, from those wild swings in oil prices. Okay, but here's where the story takes a really interesting turn. They're taking that same integrated playbook and pointing it squarely at the future. They took an old-school refinery out in San Francisco and completely transformed it. Now it's one of the biggest renewable fuels plants in the world. We're talking about using things like used cooking oil to make renewable diesel. And let me be clear, this is not some little side project. This is a massive, strategic bet on where energy is headed. So we've got this solid traditional business on one hand and this big pivot to renewables on the other. But hey, a great strategy is just a piece of paper without the cash to back it up, right? So let's follow the money. Where are they actually putting their dollars to build this future? All right, check this out. If you look at their 2026 budget, we're talking $2.4 billion. Look at how they're slicing it up. The bigger piece of that pie, $1.3 billion, isn't just for maintenance or, keeping the lights on. It is tagged specifically for one thing: growth. So, where's that growth cash actually flowing? Well, the biggest chunk, a whopping $700 million, is going into beefing up their midstream business, their pipelines. Then you've got another $500 million being plowed back into smart, high-return projects in their bread-and-butter refining business. And on top of that, they're building out major new chemical facilities. And they're not just throwing money at the wall to see what sticks. They have a very specific target for that midstream investment. Management is aiming for $4.5 billion in what's called Adjusted EBITDA by 2027. Now, just think of EBITDA as a good measure of core profit. The real takeaway here is that they're building a bigger and bigger river of steady, predictable, fee-based income. That's money that comes in whether the price of oil is up or down. That's huge. Okay, strategy and operations are all well and good. But let's get to the part you probably care about most. What does all this mean for an investor? How does this translate into dollars and cents? Now, if you're an investor who likes getting a regular paycheck, this is a slide you're going to love. Ever since they became their own company back in 2012, Phillips 66 has raised their dividend every single year for 14 years straight. Think about all the ups and downs the market has had in that time. That kind of consistency just screams strong cash-generating business. And right now, that dividend works out to a yield of about 2.9%. It's a really solid stream of income. And what's more, it's backed by a healthy payout ratio. All that means is they aren't straining themselves to make that payment. They've got plenty of cash left over to pour back into the business and fund all that growth we were just talking about. So a reliable dividend is great, for sure. But that always brings up the next logical question, right? What about the actual stock price? Is this thing a good deal? Is there room for it to go up? Well, if you ask Wall Street, the consensus seems to be a pretty firm yes. The average analyst thinks the stock is headed to around $170. But you've got some who are even more bullish, with price targets north of $200. What that tells you is that a lot of the pros believe all these growth projects we've been talking about could really push the stock higher from where it is today. All right, it's time to bring it all home. We've looked at the business, the growth plan, and the numbers. So what's the big picture here? Let's lay out the case and the risks. So, the bull case, the reason to be optimistic is pretty strong. You've got that tough integrated business model. You have very clear, visible growth coming from midstream and renewables. You've got a management team that's all about returning cash to shareholders. And on top of all that, you've got a stock that many folks think is still attractively valued. But look, we have to be realistic. No investment is a sure thing. There are definitely risks to keep on your radar. As an energy company, PSX is always going to be at the mercy of refining margins. Those can be super volatile and can really pinch profits. You've always got the risk of new regulations, and of course, if the whole economy slows down, people use less fuel, and that's going to hurt. You just have to be aware of these things. And all of this leaves us with one last big question to think about. What Phillips 66 is doing here is really interesting. They're taking their old, reliable cash cow business and using it to fund these huge investments in stable infrastructure and the fuels of tomorrow. So the question is this the blueprint? Is this balanced, integrated model the winning formula for how big energy doesn't just survive the next few decades, but actually comes out on top?